Hello, namaste, and good evening, everyone. A very warm welcome to all of you for joining us today. I'm Sonal Mittal, Product Specialist at UTI Asset Management. Over the last few quarters, investors have had to navigate a wide range of developments, from geopolitical tensions and shifting monetary policy expectations to rapid technological disruptions and changing market leadership. Against this backdrop, understanding both the broader market environment as well as long-term investment opportunities become increasingly important. To help us record these developments, we are joined by two distinguished speakers today. First, we have Mr. Vetri Subramaniam, MD and CEO at UTI Asset Management, who will share his perspectives on the global economy, markets, and the outlook ahead. Later in the session, we will be joined by Mr. Nitin Jain, Fund Manager of UTI Innovation Fund, who will help us understand how innovation-led investing can create long-term opportunities for investors. Nitin brings us over a decade of experience across equity research and fund management. He joined UTI AMC in 2018 as research analyst, covering sectors such as IT, internet, telecom, media and entertainment, and oil and gas. In 2024, he transitioned into the fund management role, leveraging his strong bottom up research expertise in portfolio construction and risk management. He is currently managing UTI Innovation Fund and Small Cap Strategy and also serves as fund manager for select offshore equity fund where UTI AMC act as investment advisor. So we will later conclude this session with the live audience Q&A. So please keep your questions coming through the webinar during the session. With that, let me begin by welcoming Vetri. Vetri, thank you for joining us today.
Thank you, Sonal. Thank you for that introduction, and delighted to be here again today and take you through this webinar. Just before we start the webinar, I was reminded that today is actually the kickoff of the Football World Cup. Now, the bad news is that India doesn't qualify to play in the Football World Cup, so we are not there. But the good news, on the other hand, is that you can support whichever team you wish to, and if they lose, you can switch your loyalties to some other team. So best of luck to whichever team you choose to support in the Football World Cup, which gets underway today. But today, what we'll do is we'll switch our focus. Many of our insights have tended to focus on global issues as well as with local issues. But today, based on a lot of the conversations that we've had and questions which have been coming in, we decided to sort of pivot and largely focus on domestic macro related issues, because there have been so many conversations about domestic macro in these recent weeks and months, in particular after the breakout of the hostilities in the Middle East and the Persian Gulf. So without any further ado, let's get going. And over to you, Sonal, to kick off today's discussion.
Sure, Vetri. Let me start with perhaps the most immediate concern on everyone's mind. The West Asia's conflict has now lasted much longer than many initially anticipated. How do you assess its implications for the global economy and growth outlook?
Sure. So good question, Sonal. And I think, the chart that we've got here, I think will sort of put that in perspective. What you can see on the left-hand side is the global crude oil, floating storage. And this is the number that let me see if I can highlight that for you. Okay, I'm not able to. Okay, there. I think got it highlighted. So you can see over there, that's the global crude oil floating storage. And what has happened is that with the conflict, the world has actually been running down the storage that was available with it. So these are reserves of crude oil which are sitting in crude oil tankers. They are literally being used as movable tanks. And also in some other offshore facilities or coastside facilities. And then because there is a reduction in supply of crude oil through the Hormuz Strait, what people have done is that they've effectively started to run down that floating storage. So basically what has come in handy during these last few months has been this floating storage, which has met the supply shortfall. The other thing, of course, which is helping the supply shortfall is, remember, the US as well as some of the other OECD economies have all started releasing crude oil that they were holding in their strategic reserves. So the reduction in supply has been met by running down these long term and the floating storage facilities which are available. Uh, Also, it is likely that there have been certain short term realignments in crude supply, particularly from Russia, which has ensured that the prices have not gone up as much as anticipated. I think when we spoke in March of 2026, just 3 months ago, I think the expectation at that point was that if the conflict persists, prices may reach $110, $120, but that hasn't happened at all. And in fact, the price is at 90, and that's because we have used the strategic reserves as well as the floating reserves. Having said that, if you look at the chart on the right hand supply side, this we are talking about the supply shortfall, and what we are talking about here is dated Brent oil prices. Now, dated Brent oil prices are different from the prices that we talk about when we are discussing crude oil, because these are the prices for dated crude, which means for delivery later. And what is likely to happen is that, as even if the situation normalizes, people are first likely to try and start filling up both floating storage as well as perhaps some of those strategic reserves, and therefore the supply shortfall is likely to keep the prices elevated. So simply put, in the short term, crude oil prices have not gone up as much as one would have anticipated if the shortfall had persisted for 3 months, because we have run down the floating storage. But in the more medium term, even if supply were to come back, because of the need to fill the reserves and the floating storage, your prices may be much higher. I'm not suggesting it goes to 140. The line that I'm drawing there essentially is talking about the need to make that market adjustment to fill up the reserves.
That's a very useful perspective, Vetri, especially because geopolitical events often influence markets through second order effects rather than immediate disruptions. So, another interesting feature of global markets has been the extraordinary contribution from relatively small set of stocks, particularly in the US. Some would argue that market performance has become unusually concentrated. How do you view this phenomena, as there are a few mega listings on the way? Has it become overextended, or is it fundamentally justified?
Very good question, Sonal. And unfortunately, the answer to that is that this will always be known only post facto. With the benefit of hindsight, we will then be able to say that, oh, yes, there was an excessive level of concentration, which typically has signaled some kind of overexcitement. One could even use the word bubble. And what we've seen in all past instances is when the stock market gets very concentrated, right? So this is the weightage of the top, whichever is the most popular theme in the market. When that popular theme in the market becomes 40% of the market, markets have tended to see a brutal sell-off, right? So it's almost like a V-shaped sell-off, which happens at that point of time, where the market first goes up dramatically and then it sells off. So this has been the pattern every time. This time around, of course, this has not yet happened. So we've only got the rally, but this concentration of AI companies is already at 40% of the US market. And if you were to start adding the three large listings that are likely to happen, remember this week is supposed to be the SpaceX IPO. Then shortly over the next few weeks, you could also have ChatGPT and maybe at some point Anthropic. All of this would mean that the market cap of these big AI plays as a percentage of total market cap would reach the kind of levels which historically have been associated with a sharp reversal. So treat this as a bubble warning, but this is not like a school bell that just because the school bell rings, everybody disperses and leaves the classroom. So no market indicator has the same kind of impact like a school bell. So with that caveat out of the way, certainly you would argue that at least the indicators are blinking orange at this point of time quite significantly, and investors should be aware of it.
I think that's an important point, Vetri. Moving to the broader economic picture, how do you currently see the inflation growth equation evolving as we look towards FY 2027?
Sure, Sonal. I think this is the trajectory of inflation, which is the blue line, and then we've also got core CPI, which excludes the more sort of volatile elements. And you can see that effectively, the CPI number, which is the headline number, tends to be a lot more volatile, whereas the core CPI in effect tends to be a lot more stable, right? Now, that is why you actually saw headline CPI go down to almost barely, 0.5% or thereabouts sometime earlier this year. But because of all the supply shocks that we are experiencing, headline inflation has gone up to 3.5%. But remember, core inflation has actually been quite stable for almost the last 2.5 years in a 3.5% range. Having said that, in the recent monetary policy, RBI revised its forecast for CPI inflation to 5.1% for fiscal 2027. That's 50 basis points higher. But important to note that inflation still remains within the comfort zone of the RBI as far as because remember their range is 4% plus or minus 2%. And remember, monetary policy targeting came into effect in 2016, which means it came into effect somewhere in this period. And that is when we had the monetary policy inflation targeting come into effect. And from that point onwards, I think they've been reasonably successful in terms of keeping inflation within that comfort zone. So that's the good news. But of course, there is an upward bias to the inflation number. However, if you just go to the next slide, it's interesting to see what's happening to growth estimates. On the left-hand side, we have real GDP growth estimates, which means this is real GDP. We are not looking at the inflation numbers. Now, RBI has just announced its own revision for GDP in the monetary policy statement. So they are now estimating that to be down to about 6.6% or thereabouts. Street expectations are even lower than 6.6%. They are at about 6.2%. So in a sense, if you see from the post-pandemic period, there is a little bit of a gradual decline in real GDP numbers from 9.7 to 6.2% current growth expectation for 2027. However, because the inflation numbers are also getting revised higher, if you look at the expectation in terms of nominal growth, which is real growth plus inflation, that may actually be closer to 12% in FY 2027, which will actually be the best, nominal growth that we would have experienced if you look at the period 2023, 24, 25, then 24, 25, 26, then this will actually be better than these numbers. So in a way, yes, real growth moderated lower, but nominal growth, which tends to drive corporate revenues and profits a lot more, could actually end up holding at the same levels as were previously expected. And this might also be feeding into the currently fairly buoyant earnings estimates for FY 27, but we'll talk about that later.
Clearly, the interplay between inflation and growth continue to influence both policy and market outcomes. What's your take on India's key macro variables which have been impacted by the crude price shock?
Sure. This is interesting, Sonal, because in the past, if I were to, let's say, particularly refer to, let's say 2013, the shock to the Indian system in terms of macro was coming from one, high inflation. Secondly, it was coming from pressures as far as the trade deficit was concerned, right? trade deficit, and of course it gets adjusted by a current account deficit being smaller because of a surplus on the services side. But those are the two pressure points. We already talked about inflation. That is certainly not a pressure point like it was in 2013. In 2013, inflation was double digit. However, this time the pain for the Indian currency is coming from the capital account, not on account of trade. So what is trade account, capital account? Capital account is nothing but the capital inflows into the country. These could be FDI, these could be FPI inflows, these could be repatriation of FDI, which is outflow. It could be outbound FDI, which means Indian companies making investments overseas. So it is this capital account which has created a issue for India, because in the past we always had a current account deficit, but we could finance that deficit with the surplus on the capital account. Now, in recent years, as you all know, one big challenge for India has been foreigners have been net sellers in India. So if you look at the last 3 years, the net selling by foreigners in India comes to almost $43 billion of selling by foreigners in India. And if you look at the last 6 years, including current year to date, in 5 out of the 6 years, foreigners have actually been net sellers in India. So this has been a challenge in terms of the source of capital coming into India, FPI going negative. But it's not just FPI going negative. On the right side chart, we have actually broken down the total change in the capital account between the period 2024 and 2026. So in 2024, the capital account had a $89 billion balance. However, if you look at the period since then, we have total outflows of $46 billion from FPI. Then we have outflows on account of FPI debt, which is about $17 billion. Then we have FDI repatriation, which is money going back from foreigners. That's also negative. Miscellaneous is also negative. And then we have some net positive flows coming through on ECB and FDI. But net from $89 billion, you are seeing the sharp fall of almost $60 billion down to minus $24 billion. So it is this fall in the capital flows which is now creating a funding shortfall to meet the current account deficit, and this is a big source of pressure on the Indian currency. If we move on to the next slide, this is looking at another aspect that, because crude oil prices have gone up and, because India has the oil marketing companies, we have not passed on the full impact of the crude oil prices to consumers. So what does that mean? It means that it is the government, either directly or through the oil marketing companies, which is absorbing the hit that the economy should be facing on account of the higher crude oil prices. How much is the hit that the government is taking on account of the fiscal loss? Remember, they made an excise duty cut. They have had to increase the LPG subsidy. B, because the OMCs are now making negative margins, the dividend that they receive from these OMCs is also likely to come down. So if you take all of this together, the total hit to the government is almost 1.6 lakh crores or 1.5 trillion rupees. The other challenge with the higher prices right now, particularly of the whole crude oil and gas complex, is, remember, these are the fuels which go into fertilizer production, particularly urea. So as far as urea and fertilizer in general is concerned, the additional liability that Government of India will have to bear, because we continue to sell fertilizer at the same price, is 1 lakh crore or 1 trillion rupees. So there's almost a 2.6 trillion rupee hit, which is coming from our policy of holding back the negative impact of fuel prices on consumers and businesses. However, there is also a positive impact which is coming through to the fiscal. One is the Economic Stabilization Fund, where they are getting the benefit of some revenues on account of taxes on fuel. Secondly, they are likely to make some cuts to capex and revenue. Finally, we are presuming that there will be no significant change in the RBI dividend, though I'll talk more about that later. So if you account for all of that, they have a net benefit of potentially 1.8 trillion rupees. So the net fiscal slippage comes down to only 800 billion rupees, which is about 20% of 0.2% of GDP. This is not a number which can really throw the economy completely out of shape, because 0.2% is a small number. Eventually we may not even resist, we may not even get to that number, depending on which way fuel prices behave. They could even go higher, but I'm just saying at 20 basis points it doesn't destabilize the economy very significantly. Another way of looking at this, or other another metric we need to look at, is on the next slide, Sonal, which really looks at what will be the impact of the current account and the balance of payment if crude oil prices remain elevated. So in 2026, the estimate was that the current account deficit would be at 0.9%, and the total current account, the balance of payments would also be at 0.9%, because net capital would be sort of neutral. Actually, the fourth quarter current account balance came in slightly better than expected. So I think instead of 0.9%, this number might look more like 0.6%. That's a minus number, 0.6%. So in a sense, this has come in slightly better on the correct number, on the reported numbers. But if crude oil prices were to remain at $90 a barrel, $100 a barrel, and $110 a barrel, then this is what the impact would look like in terms of the current account deficit. Anywhere between 2% to 3% would be the current account deficit, which is obviously significantly higher than the 0.6% that we had in 2025 and 26. And remember, RBI's comfort level is about 2% of current account deficit. Now, let's go to the next slide, because I think very, in a proactive manner, what RBI did in its written monetary policy. I know there are lots of stuff here. You can read it later, but I will essentially say that there are two tactical measures that they have taken, which will significantly drive in capital into India. One is the concessional swap facility for PSUs. Second is the FCNRB scheme for depositors. These two measures are very similar to what was done in 2013. If anything, these two measures this time are even slightly more liberal than what was done in 2013. Broker estimates, Citigroup, Jefferies, whoever you look at, is that in 2013, these two schemes raised almost $34 billion. About $26 billion was raised through the FCNR scheme. $8 billion was raised through the ECB route. This time, people are talking about broker estimates, $50 to $60 billion. As I said, depending on which broker estimate, economist estimate you look at, could come in from this route as far as capital inflows are concerned. So this will significantly plug the deficit that we are worried about, because remember, if you're talking about a current account deficit of 2.5%, let's say, that's roughly about $100 billion. If you get almost $70 billion from these two schemes, and then you get some more capital from elsewhere, you could go back to a situation where your capital account balance is back in positive territory, or at least neutral territory, or certainly not a number that we would need to worry about. So I think these above measures to attract fresh inflows and drive one-time capital flow boost is a big positive. It's a good tactical response. RBI is doing exactly what it did in 2013, so it should stop the panic. On a longer term basis, I would say these are two more interesting things that the RBI has done. It has enhanced the scope of government securities that foreigners can buy. Secondly, it has made government securities free of capital gains and withholding tax for foreigners. This has been the consistent demand from foreigners, that they don't pay this tax in other geographies. And I think just doing this change should allow India to increase its weightage in some of the global bond indices. That can result in structurally positive flows. So I'm not even getting into what can come in terms of structurally positive flows from foreigners on a regular basis because of these two liberalizations. Just the two tactical measures that they have taken should allow this year about 60 to 70 billion is the current estimate. So I think these targeted measures should certainly boost capital inflows into India, and that is very good news. Moving on, I think, one final point over here. This is India's real effective exchange rate. 100 is the baseline. When the rupee is above 100, it means that the rupee is overvalued, right? So this is the territory in which the rupee is overvalued. correct? And when the rupee is below 100, this territory, this is where we would say that the rupee is undervalued, right? So when the rupee is right now here at this level, remember it's just slightly above where it was in 2013 period. It is now at the depths of where you would consider it to be undervalued. So to my mind, we can talk about what the rupee will do in the next 6 months, 12 months, 18 months. But I always say that starting valuations have a disproportionate impact on outcomes, not news flow. From that point of view, I would believe that this starting point should actually create a good outcome in terms of the behavior of the rupee from here over the next few years. I think that sort of maybe gets us. Do we have? Yeah, I think that was about it on the economy side. Back to you, Sam.
Sure, Vetri. Before we move to the valuation and earnings trend, I would like to ask one more question. When we compare India with the rest of the world, Indian equities have seen a period of relative underperformance over the last year. How do you assess India's position today versus global markets?
Sure. So, markets are a function of psychology and what people are experiencing at different points of time. So, this is a very interesting chart because it is just saying if we take the whole world, what is India's share in the world of GDP? What is India's share in the world of world market cap? And you can see that our GDP line is continuously been on sort of a steady increase. But when you look at the line in terms of our share of market cap, when people are bullish, we go above the line. When people are bearish, we go below the line. People are bullish above the line. This is 2008. People turn bearish by 2013. We are below the line. Then from here, we see this continuous period. Then from the COVID period, we see this dramatic acceleration. We are well above the line. Everybody is bullish over here. Now it corrects back to below the line. So I would say this is a good sort of way to understand how our share of global GDP continues to increase in a steady fashion. But this number, which is market cap, because it is significantly impacted by psychology, is a lot more volatile. Starting point today would suggest that today it is a lot more opportunistically positive from a valuation point of view as compared to where it was 2 years ago. Yeah, this is the market performance by capitalization. You can see the 1 year, 2 year, and 3 year returns. Nifty 50, Nifty 100, Nifty mid cap, and Nifty small cap. And as you can see over there, on a 1 year basis, currently the Nifty 50 is the worst performing. Nifty 100 about -2%. Small cap has actually done better than I would have anticipated. Though over a 2 year period, not much gap between large caps and small caps, but the mid cap certainly doing far better at this point of time. Of course, our view for a while has been, and we'll talk more about valuations later, has been that small caps are much more vulnerable given their valuation, and large caps are preferred in the sequence of large versus mid or small. But this is what the markets have done over the last 2 years. Yeah. Now we are talking here about earnings. Last 2 years have been disappointing in terms of earnings, just 3% and 5% earnings growth in 2025 and 2026, single digit earnings growth. But the expectation for the next 2 years is quite positive at 15% each. Two ways to look at this. One, remember I mentioned the fact that nominal growth is expected at 12%. That should support corporate revenue. So maybe that is supportive of 15% earnings growth. But what we know that in the past, when there are supply related shocks, particularly in oil, Indian earnings have tended to come down. So I would still believe that this 15% earnings estimate may be at some level of risk, simply because the longer this conflict continues, I think that pattern of cuts to EPS runs the risk of repeating itself. We can go on to the next slide. I think, this just shows the trend in terms of the Nifty 500 companies, which have greater than 10% year-on-year growth. Just to be clear, year-on-year growth is not 60% and 56%, right? It is not. What we are saying is 62% of the companies in the Nifty 500 have greater than 10% year-on-year growth. 56% of companies in the Nifty 500 have greater than 10% year-on-year growth in profit after tax. So that's a reflection of nominal growth in the economy. It's a good number. It's certainly an improvement from the worst point that we were in early 2026, and it reflects a gradual pickup which is now happening in inflation. Moving on from that, we can look at the next few slides, which are more about valuation. I'll just run through these. Not much has changed. The white zone is the fair value. We are talking about the Nifty 50. It is now in the fair value zone, though slightly above that yellow line, which is the long-term average. On a forward PE basis, again, it's in the fair value zone, slightly above the long-term average. On a price to book basis, which is on the next slide, what you will see is that it is below the average line. So it is still in fair value, but now it is below the average rather than being at the average or above the average. And at the same time, return on equity is actually in the higher zones as compared to being in the lower part of this. So from that point of view, price to book suggests that the large caps, because that's what is captured in Nifty 50, are reasonably valued at this point of time. On the next slide, we've got mid caps and small caps. Not much to add except to say that both remain in that expensive zone, and that's driving our relative preference of large caps versus mid and small. Moving on to the next slide. This is the Nifty 50 yield versus Nifty GSEC. This is coming closer and closer to, this is sort of the best that we've seen in recent times. If it gets to this average line, that is where I would say the argument significantly shifts in favor of being favorable for equities. But at least we are getting closer to that yellow line. We are not far away like we were in 23-24. We consolidate all these indicators into the UTI proprietary indicator, which is on the next slide. You'll see that come up. And this is now currently in the green zone. And because it's in the green zone, this is what we call increased equity allocation zone. To be very clear, it doesn't mean that you will immediately start seeing the market going up the minute it comes into this green zone. But historically, outcomes have been positive for investors if they invested in these green zones. How positive and what is the probability of them getting positive outcomes? Why should they increase their equity allocation? That you must see this table. So 30% of the time, based on past history, the market has traded in this light green increased equity allocation zone. The average 1-year return during that time is 14%. The negative 1-year return happens only 7% of the time. So 93% of the time you're going to end up with a positive return if you invest in this space. And 56% of the time you end up with a return greater than 12%. So that is the reason that when the market based on our valuation indicator is in this increased equity allocation zone, we think this is a good zone for investors to consider large caps on a lump sum basis, but you could stagger it given the inherent market volatility. Moving on to the final slide. We've already talked a lot about this. MPC has maintained its neutral stance. Inflation estimates are higher. Yes, growth expectations have been cut, but from a corporate point of view, because inflation is going up, it may not be so negative for corporate earnings. There is likely to be some moderate fiscal slippage this year, but 20 basis points can be handled. Good news is that the India RER is now in undervalued territory. What I always say is more than the growth story and the growth narrative or the news flow, what is more important is what is the starting point of valuations. And today the rupee in terms of starting point of valuations is in reasonable territory. These proactive measures to boost capital inflows will alleviate the depreciation pressure on the rupee. And, we've talked about some of these other points. Hybrid funds in this current environment still very attractive. Why? Because, equities are in a reasonable zone as far as large caps are concerned, but you're also getting very good carry in fixed income. If you look at 2 to 3 years sort of average duration, modified duration portfolios, reasonable quality portfolios are giving you more than a 7.5% yield. So, the combination of that into a hybrid structure becomes quite attractive now. And we think investors should prefer a staggered approach towards equities. Finally, we've been saying this for a while. I must admit it hasn't happened, but we do think that the run for value compared to the broad indices has gone on very long, and and we do think that there is a good point now for some mean reversion in favor of quality growth, particularly I would say the growth element of that. So that's about it in terms of wrapping up what the macro says, how we think about asset allocation, how we think about the challenges that the economy faces, and what are the mitigating factors in terms of what the RBI has done. Large caps are where our relative comfort is. But I'll halt over here and now hand it over to Nitin. Nitin has been with UTI, I think, now for almost 8 years. I had the pleasure of hiring him 8 years ago. He's done a diverse set of things. He started with covering the IT sector, moved on to cover oil and gas as well. And then, of course, now he also covers a lot of the new age businesses. And then a year and a half ago, he took on fund management responsibility. And I'll let him talk today about the UTI Innovation Fund, which he leads. Over to you, Nitin.
Thanks, Vetri.
Thanks, Vetri. Nitin, welcome and thank you for joining us today. To set the context, could you take us through the investment philosophy of the UTI Innovation Fund?
Okay. So at a broader level, in the Innovation Fund, we're trying to identify companies and create a portfolio that can grow much ahead of the broader benchmark. So we're looking at companies which can grow for next 5 to 10 years, compound earnings at much higher rate. Let's say nominal GDP growth is 10 to 12%. That is what you can expect earnings growth from the benchmark. So we're looking at companies which can grow much higher at a much higher pace than that broader market growth rate. So there are certain set of companies which can show this kind of characteristics, such high growth over 5 to 10 years. So broadly, what we find is these are typically new age businesses. I'll talk about which all sectors fall into this, but by new age businesses, I mean businesses which are companies which are creating altogether new segments. For example, quick commerce, there was no such concept, let's say 4 years back. It's a completely new industry which has emerged. There is value commerce, companies like Meesho, which was not earlier people used to go to local shops. There was lack of options. Now Meesho has reached into tier 3, tier 4 cities in India. So there's one set of companies. Then there are companies which are disrupting the old traditional business models. So basically, these companies are gaining market share from traditional businesses. So it can be, for example, in B2B, you can think of companies like Delivery. It operates in logistics segment, which is an old segment. Means there are many companies who are operating there, but this company is leveraging technology to deliver goods at a more optimal cost structure. So these are other set of companies. Then there are innovation enablers. So India doesn't have many innovators as such, although we are finding few companies which are actually which have scaled up and which are doing real innovation in India. But in general, we don't have many innovators as such in India, but there are many companies which are enabling innovation. So this can be engineering R&D companies which are helping global innovators in terms of helping them with their innovation. There are companies which are helping innovator pharma companies globally. They're CRDMO companies. So that's the third set of companies. And then lastly, clean technology is something which we think is a sunrise sector, and there is a long growth runway. So there are companies in this sector. So there's a broader set of companies which actually fit into this theme of innovation. The other thing which we are looking at is there should be some moat in the business. So there should be entry barriers. So we are looking for companies which have significant market share in their categories, so that they can't be easily disrupted, because these are very dynamic businesses in early stage of their life cycle. So we look for meaningful entry barriers in their business, and the growth should be self-sustainable. So we look for unit economics, positive unit economics in the business. So as these companies grow, they should be able to fund their growth. So that's other important metric we look in these businesses. And some of these businesses also offer optionality. So you're getting revenue profits from certain business, but these companies are also working on some new segments, which market is not giving any value right now, but this can create significant value in future. Last thing which we look into these companies is the quality of the management, because as I said, these companies are in early stage of their life cycle, and these are very dynamic. They're operating in very dynamic environment. So the quality of the founder it becomes very important. And typically, generally, we have preference for companies which are run by founder-led management teams. So because you need that fire in the belly to operate in this dynamic environment. And eventually, so some of these companies may be loss-making at this point of time because they are very early in their life cycle. They are still in the acquiring users, building the whole ecosystem. But there should be a certain part to profitability. So at least on unit economics level, we look for companies which we think can become profitable in next 2 to 3 years. And corporate governance is something which, anyways, in UTI we pay special attention to across strategies. So that remains a hygiene factor.
Sure. Thanks, Vithin. Innovation is often interpreted very broadly by investors. So, could you walk us through the key innovation themes that the fund invests in and perhaps illustrate them with a few examples?
So these are the broader five categories is where our portfolio companies fall in, and it covers the broader theme which I discussed earlier. So one is consumer tech companies. So you can think of so basically these are the companies which are capturing the spends of next generation consumers. These are the areas where they spend their money on. For example, Eternal, it's a platform which provides convenience to maybe upper middle class or middle class or upper middle class consumers, and next generation in particular. Similarly, Nykaa is catering to similar set of population. In fintech, we have companies like PB Fintech. Misho is one company which is actually catering to the lower end of the population. So middle class and lower middle class. They are into tier 3, tier 4 cities. Urban companies, again, a more convenience-led offering. So these are all consumer tech companies, which is which is disrupting the B2C segment. The other category is B2B disruptors. So as I discussed earlier, delivery is one such company where there is a traditional large company, a large industry, logistics industry, but there's a new company there are new companies like delivery who are disrupting that old economy industry through their tech-enabled offering. Similarly, we have companies like Apple who are operating into digital advertisement. So there's a large traditional advertisement market. Apple and we know that digital advertisement is growing at a fast pace. Companies like Apple are actually gaining market share in the overall advertisement space. Then there are software companies like NewGen, which are actually participating in whole digitization trend across banks, insurance companies, etc. So that's the second category. Third category is clean technology, as I discussed. The only thing is that within clean technology, we typically prefer companies which have certain IPs or certain designs of their own. So we typically look for companies which make equipments or which make some capital goods and which own the design, rather than looking for companies which operate in the utility kind of companies, which are capital heavy businesses. So we have 3 such companies in the portfolio like Suzlon, Praj Industries, and Gravita. The fourth category is innovation enablers. Here, there are companies across different segments, but the 2 key segments to call out are engineering R&D, then CDMO in pharma, and MTI is another company which is actually enabling which is participating in this global AI capex opportunity. Last category is innovation leaders. So as I said, in the listed universe, right now we don't have many such companies. There are at least 1 or 2 companies which I can think which have got listed recently, but I think there will be more opportunities in future where the real innovation is happening in India and these companies will hit the market. So in future we'll have more, we'll have such companies in the portfolio. As of now, we don't have many such opportunities. Now. See, there's one thing unique about India. So, unlike China, India is a free economy, right? There are no restrictions on Amazon, Google Pay. We have in all the segments you can see there are global players which are freely operating in the Indian market. But despite that, India has created several local champions. So in different segments, let's say example of e-commerce, Amazon, Flipkart, which is owned by Walmart. So these 2 are global behemoths. But still, Misho is the player who has gained the largest market share in terms of number of orders. It has become the largest platform in India. Similarly, Blinkit, Zepto, Swiggy, these companies have become quite big in quick commerce. And actually, they have forced companies like Amazon and Flipkart to enter into this quick commerce industry. They're late entrants, but they have been forced by the success of Blinkit and likes of Zepto. Similarly, in fintech, we have Google Pay in India for many years, but there are local champions which have emerged. Phone Pay has gained significant market share. Paytm is a strong player in this market. So across the segments, you can see India has created it. India has its own local champions. So that's an advantage. So there are companies which are India pure plays on India, and those companies are listed in India. Can we move to the next slide? These are just a couple of examples, the kind of opportunities this segments offer. For example, quick commerce, it was a $2 billion gross order value industry in 2023. From there, it has grown almost 10x to $20 billion in March 26. But still, despite achieving that kind of scale, it is still a small part of overall retail ecosystem. And just to be clear, retail is a very big market in India, more than $1 trillion. And within that, organized and online retail is just a 20% or 22% penetration. And within that, quick commerce is just 20 billion. So just 1% penetration in the organized market itself. So there's a huge runway for growth. Can you move to the next slide? Food tech is a similar example. So first of all, the food services market or outside food consumption, that itself is a small market. That itself is a fast growing market in India. If we compare to other economies, India is still evolving in that. We still eat a lot of homemade food, while in other countries have evolved into more outside food consumption. And within that, food delivery market has just 10% penetration. So I think again here, there's a significant scope for growth for many years to come. Lastly, digital advertisement. So globally, it's a fast-growing market. Even at this scale, for example, in the left-hand side, you can see the globally it was for almost $500 billion industry and expected to grow at 15% CAGR. And in countries like India, the penetration of digital is even lesser, at around 35 to 40% versus global penetration of around 70% or so. So I think this is another industry where there is significant runway for growth, particularly in emerging markets, including India and several other countries. And lastly, I talked about clean energy. So that's, we all know about government's target of achieving 500 gigawatt of renewable energy in next 4 to 5 years. And we are seeing real progress on that. I think that's a big sunrise industry which can evolve over the next 5 to 10 years. So those are the bigger trends, examples of some of the opportunities.
Right. It's interesting to see how innovation extend across multiple sectors and business models. Nitin, within these themes, what kinds of businesses does the fund typically look for? And could you share some of the characteristics that help identify a potential investment opportunity?
Yeah. So let's take example of Eternal, right? The company got listed with the name, it was called Zomato then. Since then, company has evolved into a consumer internet platform with multiple businesses. But when the company got listed as Zomato, it was just the food delivery business, which we were giving the left-hand chart below. You can see that how Street was valuing different businesses over at different points of time. So when the company got listed, we were just giving, it was only food delivery business. But later company acquired this company called Grofers, which later became Blinkit. Initially, Street was giving negative value to that because people were not convinced on the market opportunity, what kind of execution Zomato will have. But we knew that Zomato had a proven track record in food delivery. Even at that point of time when they got listed, there were two companies in the same area, Zomato and Swiggy. And Zomato had done much better job in terms of gaining market share as well as showing profitability. So Street has it. People had their own concerns on Blinkit or quick commerce, whether how this will scale up and how it will become profitable. But over period, as you can see, quick commerce has overtaken food delivery in terms of per share value of the business. So, for example, at this point of time, food delivery business gets around 100 rupees or 120 rupees kind of value per share, while quick commerce business has overtaken food delivery. So these kind of optionalities, I think there are present in many other businesses. So while we value company based on the current business which is doing well, but there are optionalities which can actually unlock value in future. So that's one example how it is played out in case of Zomato or Eternal. The other example is the Apple. As I discussed briefly earlier, it's an advertisement technology company with a very unique business model. So they get paid only after they achieve certain outcomes. For example, if let's say Nike, they are facing a problem. Let's say customers come to their platform, they add products to the cart, but they leave before buying the product. So the use case here will be Nike wants someone to get that transaction completed. So Apple is one such company which actually does that work for Nike. So they actually find users who left the cart without completing the transaction. They get that transaction done, and they get paid only when they do their transaction. So it's a completely outcome-based business model. And in that business model, company has shown consistent 20% profit margins. They've been growing at 25% CAGR, and they generate very decent level of ROICs and good cash generation. The company has almost 13 patents in their name. One of few companies in India which owns so many patents. Means we don't find many companies who owns patents in India, so many patents. And these patents are across the geographies. Means they have patents in Singapore, US, different geographies. It's a very unique business which we think has potential to compound at 20% plus rate over many years.
Yeah, I think this clearly highlights the importance of balancing innovation potential with business quality and execution capability. From an investor's perspective, what would you say are the key factors that make the innovation fund a differentiated investment proposition?
Yeah. So see, the first thing is this is a true to label fund. So when we're talking about innovation, the theme I talked about earlier, we're looking for high growth companies which are doing some disruptive work, and where we think growth can continue at higher rate over the next 5 to 10 years. So we're not trying to find next 2 years high growth opportunity. We're looking for structural opportunities here which can compound at higher rate over next 5 to 10 years. So you will only find stocks which fit into that theme. So you won't find those traditional companies which are doing innovation at margin. So all companies do some innovation in their business, right? So they might be 2% revenue, which might be coming from some new initiative, 5% revenue, 10% revenue. So you will never find those kind of companies in this portfolio. Second is, say it's a concentrated portfolio. Since we are true to label and we are sticking to the theme of the portfolio, it's a very concentrated portfolio. So our investable universe is just 65 to 70 stocks. And out of that, we have created this portfolio of around 28 stocks. I'll discuss about the constitution of the portfolio and characteristics. But the key thing which stands out is the compounding which it can offer in terms of earnings growth and the true to label nature of the portfolio. So as you can see here, it's very concentrated portfolio because of the limited universe and the theme we are following. So we have around 27 stocks in the portfolio. Top 10 stocks have 55% weight, and the active share you can see is 96%, which is a proof of our style that we are not going across. We're not trying to find opportunities within the benchmark. Actually, we are doing bottom-up stock picking here, which fits into the theme. Since many of these companies are in early stage of their life cycle, you'll find large cap representation in the fund is just 9%. And even that company, 9% is Eternal. So I wouldn't say that is also a mature company. Even I would say that is also a startup in a way. So portfolio will always be more tilted towards small cap and mid cap. And valuations, typically in this kind of fund, your traditional valuation metrics of price to earning, price to book of next year, that doesn't work because these companies are very early into their evolution. So the way we look at valuation is at steady state, what kind of profit metric or profitability these companies can achieve, profitability, cash flows. And on those metrics, we try to look at whether these companies are expensive or cheap. So these traditional metrics don't work. So the PE, the prima facie PE ratios and EV EBITDA price to book ratios will always look very expensive here. I've already discussed that it's completely bottom-up stock picking here. So you will find that the active share versus benchmark is very high, and there is very low overlap compared to other strategies within UTI IMC. This is a detailed portfolio, means I won't go into each stock here, but yeah, this is the broader portfolio. So it's 27 companies in the portfolio.
Sure. Nitin, like you said, the fund follows a true to label approach. Could you explain how you identify suitable investment opportunities? And is the universe of companies that fit your innovation framework sufficiently broad and diverse?
Yeah. So, see, the starting point is we try to look at themes where we think there's a long runway for growth. So that's the starting point. So which are the areas where we think we can find structural growth opportunities? And from there, we go into business models where the unit economics we think can be positive, or where we think company has already demonstrated that this business can be grown profitably. And then we look for the quality of the management, what kind of potential cash flows and returns this company can generate. So that's how we select the stocks in the portfolio. Now, on the investable universe, I would say, given our strict investment philosophy here, the universe is much smaller. So let's say if you look at BSE 1000 stocks, within that, just around 65 to 70 companies, which typically fit into the theme which I have discussed and the philosophy which we have. But the good thing is that universe is expanding. So had we spoken, let's say 1 year, 2 years back, that universe was very small, around 50 companies. From there, in next 2 years, it has expanded to 65 to 70 companies. And I think there are many more companies which are in the process of getting listed, which are in late stage of their funding cycle. So I think this universe will keep expanding in future. So right now we have 27 companies in the portfolio. I think in future, as we have more options and more investable opportunities, more businesses which we like, the size of the portfolio or the number of companies in the portfolio can go up. It will remain a concentrated portfolio, but it can become much more diversified than it is right now. Another thing, the opportunities which are available within the universe are quite diversified. So if you can see the right-hand chart here, these are the basically number of companies, the IPOs which have happened across sectors in the recent years. I think it's well diversified across e-commerce. Within e-commerce, you will find there are different types of companies. So there are horizontal e-commerce companies, there are vertical e-commerce companies, there's a value fashion e-commerce company, there's I think companies like urban company which are into very different kind of business than a Zomato or a Nykaa. So even within e-commerce, you have diversified businesses. And then we have fintech, enterprise tech, which is B2B technology software and software companies. There are some companies which have come into real estate technologies. So it's much more diversified set of universe. And I think this is going to further diversify as we go forward.
Sure, while we are running on time, but I would like to take the opportunity to ask one more question because this is very pertinent. As investors evaluate an innovation-focused strategy such as UTI Innovation Fund, what are the key considerations that they should keep in mind?
So see, this is the kind of companies we are investing in, the early stage companies. They tend to be very volatile. Means, for example, let's say, I can take very simple example of Eternal. We have seen the kind of volatility which is there in their stock price, and that comes not just because of the business, but also because of external environment. New company raises fund, they start competition. There's a next 3 to 6 months they burn money. These companies have to react. So these are very dynamic businesses, so they can be monthly, monthly, quarterly volatility in this kind of stocks. So this strategy is very high risk, high return kind of strategy. So anyone looking to invest here should have a long-term investment horizon. So typically we recommend this strategy to investors who have 10 years or more than 10 years kind of time horizon, and who can withstand that kind of volatility in terms of stock price performance or NAV movements of the funds on monthly basis. So that is the first thing is the person should have higher risk appetite and longer term time horizon, investment time horizon. What this strategy offers is a long runway of growth. Means if you're looking for compounding at a very high rate, and these are companies which are actually which will be maybe some of this will become actually Eternal has also already become part of the larger benchmark. I think there will be more companies which will come into benchmark. So some of these companies will become the blue chips of future. So if you have investment horizon of 10 years, 15 years, I think you will find some of these companies becoming the large caps of future.
Sure. Thank you, Nitin. Let's now move to the questions from the audience. We have received several interesting questions during the session. Maybe, Vetri, you can take up this question. You mentioned no West Asia conflict, but beyond oil, how exposed is India specifically to a Strait of Hormuz disruption, given our fertilizer imports and LPG dependency?
Sorry, good question. And wise question to ask. Actually, our LPG dependence and fertilizer dependence is very, very significant. I don't remember the exact numbers offhand, but I would think it is maybe higher than 50 to 70% of our total requirements of these two. Either the end product or the supply chain is disrupted for these two. So I think it is a significant concern. Having said that, I think just yesterday there was some news of a new fertilizer tender which India had floated, which suggested that after spiking almost 100%, the prices of fertilizers in the latest tender have come down by about 30-40%. So maybe there is some rebalancing which is now in place. But yes, we would worry a little bit about what is happening on fertilizer. Good news, the Kharif crop, which is the crop which will now go in the ground, seems to be in a reasonably good shape in terms of the supply of fertilizer to meet that. But for the Rabi crop, which is later in the year, there may be some challenges. So certainly these are ongoing challenges. But again, when I presented the fiscal account, we had accounted for 1 lakh crores as the additional cost on fertilizer. I would say that is reasonably budgeted. The refineries have been asked to produce more LPG, so their margins may come down to some extent. That will get reflected in lower profitability and dividends to government. But I think we'll be able to solve the problem for LPG.
Sure. Peter, you also mentioned about RBI measures announced in the recent June policy to shore up the rupee. Does this signal a deeper stress in India's balance of payments than the market has acknowledged? And also, how long does it usually take for these interventions to show results? And what is the medium-term outlook for INR?
Right. I'm not a soothsayer, hard to say that, but let me just point out one thing. This $70 billion may not necessarily result in a appreciation of the rupee, because the way this works is that those people will go to the RBI will execute the swap and give them rupees. So, it doesn't create a market pressure in favor of the rupee. So that is one important thing to understand. In 2013, there was a little bit of a V effect where the rupee collapsed dramatically and then recovered on the back of these announcements. But this time, I think the fall itself is not as dramatic, and therefore, unlikely to see a very sharp move. I'm not sure how much appreciation you might get in a significant manner, maybe a few percentage points here or there, but that's guesswork. I don't have any scientific way to predict that. But hopefully from these levels, because you are now in that undervalued territory in terms of RER, if my longer term expectation was 3% per annum depreciation, that expectation should now be significantly lower than 3%, because you already are in a RER zone, which is quite comfortable.
Sure. Thanks, Vetri. Our next question is fund related. So maybe Nitin, you can take this up. The private capex revival in India is being driven by clean energy, EV, semiconductors, and defense sectors that are genuinely innovation intensive. But many of these companies are either unlisted, pre-revenue or early stage. How is the fund navigating this gap between where the most exciting Indian innovation is happening and what is actually investable in the listed space today?
Yeah. So we have limited opportunities available in the listed space as of now in the areas you talked about. But there are some companies which are actually enabling this kind of ecosystem. So, for example, one company we discussed is MTAR, which is actually participating in this AI theme. They supply components for data center power backup. So that's the kind of one company we have in portfolio. Then in EV, there are a few companies in the listed universe, but again, we look at many other things. One is presence in the theme, but the second thing is do we like the business model of that company, the profitability, cash flows, etc. So there are other concerns because of which we haven't invested in those kind of companies. I think I see many such companies, interesting companies in the private universe, and some of these companies are getting listed. They are in different stages of pipeline. So I think maybe in a year from now, we will have some more options to invest in and participate in these themes.
Sure. Nitin, there's a follow-up kind of question here. Since there are limited pure play, unlike some of the global markets, India does not have many pure play AI or deep tech companies listed. So, given UTI Innovation Fund's innovation thesis more dependent on Indian specific innovation stories, do you see this as a feature or a limitation?
So, see, in this fund, we are trying to capture the growth opportunity in India. So that's the primary area we are targeting. But there are companies which are actually benefiting from this global trend. So one such company I talked about earlier, MTAR is one such company. We're looking at, for example, there are clean tech companies, for example, right? Not related to AI, but they can have play in power. Basically, AI or data center power is important. One important input which goes into it, and that's a big problem to solve. So there are companies which are actually participating in those areas. So we evaluate those kind of companies, but the primary I think metric for us is those businesses should make sense in terms of the profitability, ROC, cash flow generation. So whichever companies fit into that those criteria, we evaluate those companies. As of now, there are very few companies, a couple of companies in the portfolio which are actually participating in that global opportunity.
Sure. Thank you, Nitin. Vetri, I would like to take up the next question. While foreign investors continue to be net sellers, domestic SIPs and retail participations have become a key pillar supporting Indian equities. So, do you see this structural domestic bid continuing even if market remains volatile for an extended period? And how sustainable is this domestic liquidity support if global risk of sentiment accelerates?
Good question. Let me just put it this way. I think there is a significant structural component within the allocation that Indian investors are now making towards equities. Having said that, we know that even within every structural trend, there are cyclical patterns. So I would not suggest that you can, underwrite that number of 30,000 crores a year with like a hard line. There can be cycles around that, and it would be foolish not to expect that there will be some cycles around that. But I think it's a given that, as the country becomes more prosperous, and there is certainly a segment of society which is, earning incomes which is well above the national average, they do have disposable incomes, and their ability to allocate to risk capital from both a lifestyle, financial goals, and ability to consume risk point of view, they will make those allocations. So this is a natural outcome of the trajectory in which people are benefiting from the growth of the economy, that they have higher risk appetite. So as I said, I will expect it to grow. Last 5 years have been frenetic in terms of pace. Can the pace slow down? Yes. Can you see cyclical patterns? The answer to that is also yes. Most things in life are cyclical. It is just an illusion at one point of time that it appears that there is no cycle around it. But the structural trend, I still think, is a gradual step pattern, and that is an upward facing step pattern.
Sure. Thanks, Vetri. Nitin, next question is fund related. Innovation investing often requires balancing conviction with discipline. So, could you walk us through what typically triggers a new investment idea for the fund? And conversely, what factors would lead you to reduce or exit a position?
Right. So I already talked about the kind of how we evaluate companies which can form part of portfolio. That we have discussed, but let me explain how we build position in the portfolio. So how do we build conviction, and how do we build position the portfolio? So let's say, see, we start generally with a small position because many of these companies don't have long listing history, and in some cases these are IPO companies which we start investing in, although we are very selective in terms of participating in the IPO. But these companies have limited track record, so we typically start with a small position. Then we observe these companies for some time, build conviction. If we have more conviction in the business and valuations are in favor, then we build up the position. And in case where valuations are in favor, and we have high conviction, we go as high as let's say 6%, 7%, 8% also in terms of holding. In some cases, it has happened that we have built small positions, and then later we realize that these companies don't have those kind of businesses. Means the business model is not as strong as we thought earlier, because this understanding comes with the time. So in those cases wherever our thesis proves wrong, we typically exit from those stocks. So that's the kind of thought process in terms of how we build positions and how we exit. And in some cases, the exit decision is because of valuations also. If it becomes too expensive, then we reduce the exposure. So that's the other way of managing the position.
Sure, thanks, Nitin. Since we have already run ahead of time, I will just take one last question. Vetri, this question is for you. If you had to pick one macro variable and one market level variable that investors could track most closely over the next 6 to 12 months, what would each of you pick?
Sorry, you said one macro variable.
Yes.
The second one is?
And market level variable, if you have to pick some variables.
Market level variable is very simple. Just track the UTI Proprietary Valuation Index. I think it's a composite of everything. As I said, people think you have to watch for news flow to make money. To my mind, starting valuations are a far more important determinator of what future returns can look like. So that is pointing and telling you how to react to the current situation, not to the current news. Respond based on valuations. As far as economic indicators are concerned, honestly, I believe economic indicators are, all over the place. And the thing about economic indicators is that most things in the economy I have come to understand as always double entry bookkeeping systems, right? So one economic indicator captures something, but it doesn't look at what is the other side of that same economic indicator, which could be telling you something else. So honestly, to me, economic indicators from an investing point of view mean very, very little. Having said that, if you really put a gun to my head and say which economic indicator to me always gives me a sense of when the economy is showing momentum and when it is not, I would say rising credit growth is always been a positive in terms of trajectory, and falling credit growth has always been a concern in terms of a slowing economy. So to me, credit growth, because it also has certain behavioral aspects built into it, is normally a good indicator of the trajectory of the economy.
Thank you, Vetri. As we come to the end of today's session, I would like to thank both our speakers, Vetri for sharing your insights on macros, markets, and India's outlook, and Nitin for helping us understand the investment philosophy and opportunity behind UTI Innovation Fund. To all our participants, thank you for joining us and for your engaging questions. We hope today's session has provided you useful perspectives to help you navigate the investment landscape more confidently. On behalf of UTI Mutual Fund, thank you once again for being with us today. Stay focused and stay invested. Namaste.
Thank you, Sonal. Thank you, everybody.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.